the timing of China's rise and the natural end to their growth cycle, much like the US in the 50s and 60s, the post-war dividend led to the 70s. As you reach the end of that natural growth phase, China has reached that. And so once you reach the end of that, the playbook changes. So it's not just COVID, but COVID strongly contributed to that rise of China de-globalization factor. First one, de-globalization. Okay, that comes back to the rising power that Dalio is talking about. Now, there's other things to think about with China and the rising power, but one is that the US and China control global trade mostly. And so when we deglobalize those supply chains and corporate and country alliances and treaties and whatnot, that's inflationary. That's inflationary, okay? That's the first D, and we're in that environment. Ray Dalio, okay? There's a great firm in Canada called BCA, the Bank Credit Analysts. They coined a term many decades ago. I used to read them every month. They have a monthly newsletter, very well written, very well researched, BCA. They call it the debt supercycle. And that's what Dalio is alluding to, is that there's these, great cycles that might happen every 50 to 100 years. Now, the why they happen is not something we're going to touch upon, but the fact that they do happen is a real thing.
Hi there, I'm Sifu Slim, and I am coming to you live from Playa del Carmen, Mexico, where I'm in a palapa that looks like a straw hut, but it's a giant straw hut at a restaurant in a boutique hotel with really good Wi-Fi. So I'm excited today to be sharing some observations, some actionable steps, some things that we can look to execute in our program, the way we think, the way we look at knowledge and information, so it'll help us make the right decisions and understand things like the financial markets, the global economy, geopolitics. All these things are interrelated. And someone who studied a lot of that and who has shared a few conversations with me, Sifu Slim, in the past is Jason Jewell, a Princeton grad from 20 years ago, and who's worked in finance, who's been a professional athlete, and is a student of all these things, and also has done a lot of things with working with other businesses, trying to show them his plan, trying to find out what their goals are so that they can kind of come together, meeting of the minds, and look at things in a global perspective, a holistic perspective, and also what we have to do today, what the first few steps are to meet some of these needs and goals that we have. So over to Jason for a little more bio and share with you, Jason, a little bit about your wrist injury.
You don't want to hear about that. But Sifu Slim, how are you? It's great to see you. It's great to be back on the channel. And yeah, just to jump into it, my background, 25 years as an investor. And I like you, Sifu, am sort of a bit of a polymath, and I just really just look at a broad context. I believe in holism. My email, in fact, is holistic.investor. So it's very much in my DNA and blood in terms of looking at truly the broad scope of the picture. And I think it gives investors, since we're talking about investing today, a lot more comfortability to do the heavy lifting and hard thinking of painting the backdrop of where we have come from, where we are, and allow a roadmap of where we're going, so as to reduce a lot of confusion and stress when allocating your capital and making financial decisions. So if you look at a lot of the market participants at any given time, you know, a lot of these participants are scratching their beard. They're stressed. They don't really know what to do. They make a lot of mistakes. And investing's hard, period, right? But my main message to you today is that if you do a lot of that work and create a framework for, you know, a 5-year period, a lot of the markets will run, you know, in 10-year periods, right? It's really layers of the onion. But if you're looking 10 years forward, you say, okay, this is the framework, and make little adjustments as you go, because nothing's static, obviously. I find it to be a much more enjoyable experience. So that is what, you know, I think, you know, setting the table for that is the hard work that allows you then to drill in and say, okay, how, you know, what are some actionable items that I can do today in the next year, or how does my next year playbook look and fit in with my 5 to 10 year outlook? I think so. That's a different framework from how most market participants, most YouTube channels, most media outlets, CNBC, it's how they function. It's always the next quarter. And, you know, if you're lucky, the next 12 months. So, and I just do a little bit of plug on my background. My background is really in 25 years. I worked on Wall Street as a squash player, which don't laugh, but that was actually very valuable because I was able to function as a squash player on the inside and really get into the heads and mind and thoughts of all the players on Wall Street. You know, whether portfolio managers, analysts, CEOs of large investment banks, and so on. And so I got to see in the 90s, the run up to the dot-com boom. I got to see how they were thinking, which was very informative. And then I got in the markets before 9/11 and operated successfully through the dot-com crash and recovery, and also very successfully in the Great Recession. Crash, you know, I called the recession in 06 for 07, shorted the market, oil, and financials in 08, covered my shorts very well at the end of November of 08, and bought gold and silver in the summer of 08 and doubled down in November of 08, and did really well there, and also in the recovery there. And importantly, in the early 2000s, I called basically a quote unquote fake recovery through the 2000s. And we can get back to that as we get into our discussion. But I nailed that too. And then and then I was right on that for the 2010s. I think I said 2000s. For the 2010s, I was right on the fake recovery. And I said then this is what I said in 2010, by the way. So as we were recovering from the Great Recession, I said, okay, fake recovery, and then the 2020s, watch out, because eventually it comes home to roost. And here we are. We're in a very difficult, volatile 2020s, and you know, now we can talk about what's going to happen from here. But I did that co-managing a $6 billion equity fund. So it wasn't just YouTube channels and newsletters. I was actually in the hot seat managing billions of dollars for an institutional professional portfolio with client assets like Honda Motor Corporation and the Baltimore Fire and Police, the Diocese of Oakland. We had large and diversified institutional clients. So there you go. Over to you.
Thanks, Jason. So fascinating stuff. In the trenches, really important. While you're a dad for part of that time, and while you are a squash player playing at an elite level as a pro squash player, and then playing, you know, in the regional tournaments and some national tournaments through part of that time, and then having a child stepping away from squash and focusing on family, which is really important. And while you're doing some other things with your assets, and I got to watch a good swath of that. And I was pursuing some similar things, except not having kids at the time, just having the significant other and weathering the storm. And one of my claims to fame is that when I found out that Trump was lying about COVID, and he knew what was going to come down, and he kept telling the national media, international media, that we don't have a problem. I said, this is the time to short the market. And in one day, by having buying the triple inverse fund of the S&P, I was able to make, I think in one day, 175%. So it was probably out of like a chunk of money, one of my best moves I ever made. The mistake I made was not realizing that in 87, the market was pumped by fictitious money very shortly after the crash. Black Monday, I believe it was called in 87. Is that correct?
Mm-hmm.
And so I held on for part of that money a little bit too long, and you had swing days of 1,000 points up in the market. So that was crazy, and that was this fictitious money. So this brings me to someone that you and I have both looked at for strategies, for research, for long lists of data and statistics. And this is Ray Dalio, who's been known as one of the top 20 most wealthy people in the world. I don't know if he ever sought to be that, but he grew up lower middle class in the New York area, went to a state school, caddied for Richard Nixon on Long Island, said that Nixon, when Ray was 17, 18 years old, Nixon wasn't very friendly, wasn't a good tipper, but Ray Dalio is kind of a steady pony, just kept chipping away, getting into the financial world when he didn't come from an elite background. He did go to Harvard, got an MBA, so I would call him a grinder with good intentions. Let me know what you think about that way of summing up part of the lifespan of Ray Dalio, who's still alive at age 74.
Yep, he's a grinder. He is the captain, or I think he's stepped aside maybe now, but the largest hedge fund in the world. And he came to the fore in the late 60s, and through thick and thin built his firm. Some of my friends worked for Bridgewater, and he comes across as this elder statesman, but it is a brutal sink or swim environment at Bridgewater. And so as an elder statesman, that's the role that Dalio is playing now in his 70s. He's writing books and trying to explain things in layman's terms. I think that's clearly one of his missions at this stage of his life, is to try to edify the general public on how do markets work. And he does so, or his framework of the world is to build a set of principles or about oneself and the way in which you look at the world. And that's how he has navigated this 50, 60-year run of his. And I think he's trying to help people understand those principles and build a similar framework so that they can try to understand what's going on.
If you want to succeed, understand the 5-step process. What I mean by the 5-step process is, first, you need to know your goals. That means you need to prioritize and find out, what do you really want and what are you going after? On the journey to those goals, you're going to encounter your obstacles, your problems, and so on. So step 2 is encounter those and don't tolerate those. Then number 3, what are those impediments? Get to the root cause of why you're not getting to your goals. Is it weaknesses that you have, impediments of others? Step number 3 is diagnose to get at the root causes of those. Step number 4 is to then, once you have that diagnosis, design a way to get around that, practical way to get around that. Maybe you have help that you need in some area, and then when you design it, you have to go to step 5, which is to do it. In other words, a lot of people come up with a lot of designs, but they don't then follow through and implement those designs. Everybody who does that will move toward their goals and succeed, and those who are failing, fail at one step or another. So observe yourself. What is it that's causing you to fail? Is it, for example, that you don't follow through on the things that you need to follow through in, or that you don't accept the barriers and deal with the barriers? Anyway, that's the 5-step process. If you get in the habit of doing it, you'll do it all the time, and I guarantee you that you'll move forward toward your goals.
And the thing that is, I think, different about Dalio, he's a self-proclaimed mechanic of the markets, and so he's very just like an orthopedic surgeon. He's just very mechanical about how he looks at the markets, and he's a historian.
Yep.
So he's gone back 500 years and studied various cycles and looked at all the the main variable interest rates, inflation, and so on. And debt, yeah, all the main variables, and trying to explain where we are right now through that lens.
In my years of doing this, so something like a little over 50 years, what I found is that many times in my life, things that surprised me were because they never happened in my lifetime before, but they happened many times in history. So, for example, then studying these earlier times, if they happen mechanistically, I need to know how they work. So I studied the Great Depression. That's why we anticipated the 2008 financial crisis, because the same things happen over and over again, but sometimes not in our lifetimes. And so there are three big things that are happening to us that haven't happened in our lifetime. I like to measure things so I can see them in numbers and charts and so on. And those three big things are, first, the amount of debt and money creation, how much debt we have, the rate at which we are creating it, and then where we're getting that money from, the Federal Reserve and other central banks printing it. So that has never happened to this degree except for the 1930 to 45 period, which I studied before, and I needed to go back and study that in history. The second of those two things is the amount of internal conflict, populism of the left and the right, irreconcilable differences, with the largest wealth gaps that have existed. So the greatest political gaps, the greatest amount of populism, largest wealth gaps since you have to go back to the 1930 to 45 period, and actually it's larger than that, and you have to go back to 1900 to see that. By the way, if you want to see it, you'll see the charts in that. So we have a financial issue. We have an internal conflict issue that has very big implications for how well our country is run, but also what does it mean for taxes? What does it mean for the value of assets? I need to understand that. And the third was international conflict. So in my whole lifetime, the United States was clearly a dominant power, and we were in the American world order. 1945, the United States became the leading world power, accounted for half world GDP. We had 80% of the world's money, because gold was money then, and we had a military monopoly. And so the reason that we were the world's power, that's why the United Nations is in New York, and IMF and World Bank are in Washington, so dominant. But we could see this conflict, this emerging competition. And the last time that happened was the 1930 to 45 period, and I need to study that. And so I studied that pattern, and these are the big things in our lives right now, but we are not acquainted with it. And so I needed to study the rise and declines of currencies, the rise and declines of empires. And because these cycles go on over a long period of time, I needed to see enough of those cases, so I had to go back, let's say, the 500 years. So I studied all of those.
And so that's a different lens than most market participants that are very short-termism. And so that, I enjoy that. I appreciate that about Ray.
For regular people out there that don't understand the intricacies of option markets, foreign exchange, the Forex market, stocks, bonds, mutual funds, limited partnerships, closed-end funds, all these different things, and if the list keeps going, they're really, if you want to boil it down to a few different pieces, you've got real estate, you've got stocks, you've got bonds, and you've got cash. That's a good basket to consider for the regular person that has an extra $10,000 to $50,000 that the regular person now may have $50,000 that they want to save per year between husband and wife. And believe me, if you don't do the savings and you don't at least save that money with a little bit of interest, you're going to have a world of hurt when you come to age 50, 60, 70, when you don't want to work anymore. So someone like Ray Dalio, who's bringing that down to the intelligence level and the time available to the person to make sense of these type things and make a good long-term plan, he's very good at that. And he's also good at people like us who studied the market, study the intricacies, the history, the tulip crisis in Holland, these types of things. And he can break that all down, and he does it artfully well. Over to Jason for his thoughts on my summation.
What you're talking about is asset allocation. And so you're right. For the average investor, you don't want to get into very sophisticated, confusing investment vehicles, right? An ETF, an options contract, is an investment vehicle. It is not an asset class. Okay, that's very important, right? It's the wrapper in which the asset sits. So that's all way too confusing, and Dalio knows that. And Dalio is basically recommending, for an average investor, what should you do? And he starts with what I would agree with is that the allocation must shift to a more diversified basket. For the last 40 years, we've essentially had a basket of what's famously known as the 60-40 basket, right? 60% stocks, 40% bonds. That basket performed really well as interest rates from 1982 fell over 40 years to 2022. It structurally fell. When interest rates fall, bonds go up. So it was a great double-digit opportunity, double-digit return opportunity for bonds to perform well. And stocks, of course, over 100 plus years have gone up 10% a year. And when interest rates are falling, stocks do well. So you had an environment where both could do well, and they would also kind of play off of each other too, and give a little bit of risk management. We're no longer in that environment. Bonds are at best valued. Stocks are overvalued, especially U.S. stocks. Foreign stocks is a different picture, which segues perfectly into Dalio's point. You should have a different mix than that 60-40. A lot of investors, I've been saying this for years now, but a lot of thought leaders are saying, more like 20-20. And the third, that 20% is alternatives. And alternatives is everything that's not stocks, bonds, and cash. Okay, so real estate is considered a alternative, but so is private credit, private equity, hedge funds, infrastructure, precious metals, commodities, collectibles. It's a broad, very broad bucket. And so, I think Dalio is saying you should own 5% in gold. Well, I think the average holding of gold might be like 0.5%. So there's scope to increase that by tenfold. So just leave that with you, Sifu, that the point that Dalio is trying to make is keep it simple and keep it more diversified than what you're used to in the last 40 years, so as to recognize that we are in a sustained volatile market environment. And that's the best risk management tactic to take for an average investor, to not have to continually stress and dote over their account, right? Correct. So it's a basic shift that that investors would be they would do well to adhere to.
So imagine a guy. Thanks, Jason, for that wrap up. Perfect. The wrap up that Dalio's giving with all of his years of experience, which I imagine if we stepped in on a car trip to the golf course in 1975, 1984, and we had time, he would have been telling us very similar things back then, because he's always been a student of history.
And so I needed to study the rise and declines of currencies, the rise and declines of empires. And because these cycles go on over a long period of time, I needed to see enough of those cases, so I had to go back, let's say, the 500 years. So I studied all of those. Now, I'm not an academic, I'm a practitioner. So it's not like I'm writing history books. It's for the purpose of making decisions today. So what I learned there has been important in our positioning in the markets right now. So it's just that practical.
So imagine someone running a company that has 1,000 employees or more, and he's got to have meetings with managers and sub-managers and staff, and probably gets on the the version of an intercom call back in the 80s to a Zoom call over the last 10 to 15 years, all these types of things. So a very busy schedule. I imagine he has a family that he had to raise, and then nonprofit and things like that he was doing, plus travel. But here's a guy who has the time to break out history books and to come up with numbers like an economist does when they look at an economy. And he did this with, Europe and the United States quite a bit. I imagine he studied Asia. So he looked at all of this stuff and he wrote books, and he's very productive. So you and I get to benefit. So here's what I would tell the viewer, especially busy people: let other people do a lot of the legwork for you. That was their passion. That's what they put their time in. That was their expertise for a period of years. That's what books do. And that's the gift that you have. Yes, videos are great on YouTube. You can watch them, or you can treat them like like radio and listen to a video. All that's wonderful. But when you take a book of Ray Dalio and you spend a week or 3 weeks, and then the next year you read it again, there's something special about that, because you could absorb the mental state of Ray Dalio when he wrote that book, and when he edited, and all the research and the archival things that he had to look into. And that definitely brings to bear things that we can use in our thinking, in our planning, in our strategizing, and in the action steps that we take today or 3 years from now, based on patterns and strategies we've learned from hardworking people, gifted people like Ray Dalio. Over to Jason, maybe share some of your thoughts on that and why you picked up Ray Dalio's books and over the past 10 to 15 years.
I think I've shared most of what is shareable to the viewer here about Dalio. From the basic layman's standpoint, we covered it, the asset allocation fact. Beyond that, he goes into principles that can help you in your personal life. And he's because he's a student history, if you're academic, you'll enjoy the read. And so he writes his books in a very readable format, giving great anecdotes about his life and journey. But if we want to drill down to the next layer of the investing conversation, you can raise the bar a little bit and go into an intermediate level of investing for the viewer, to kind of paint a picture for the investment backdrop. Would you like to go there?
Let me ask you one question before we go to that next step, and that is about debt and the debt cycle, which is something that I've been studying via Ray Dalio and other people. He's basically saying that if you print money out of thin air, and it's been done throughout history, that's why we have the foreign exchange market. That's why we value other countries' economies, and why the United States fights war to keep the oil trade in petrodollars and the US dollar. And so this control of money, and then the idea of printing more money and what its value can be, like during the Weimar Republic, or when any country's economy collapses and the money is not worth anything. This is all part of the debt cycle that he talks about. And so my question to you, Jason, I think I've been looking at that with you and asking you about it for about 4 years, is if an economy keeps printing money, let's say the United States, and they do it, and then the other countries that are major players have to react to it, what happens if finally we say, none of this money is of any value? We don't trust your currency, you don't trust ours. Does it come to war? What happens in the interim when these debt cycles get out of whack, and the fat cats, the people who control the worlds and the corporations, have all of these assets built up, have all these gated communities, maybe have armed guards, and now the regular people are watching the idea of a collapsed economy where their money, like in the famous Christmas movie, It's a Wonderful Life, where there's a run on the bank and the bank can't provide any money, and you don't have anything with which you can buy food and survive. So over to Jason for some comments on that.
It's very important to understand history. That's why we're talking about Dalio. It's a very complex multivariable equation to understand. People like to say history doesn't repeat, it rhymes. Like you have to understand what's happening and why to understand why we're here. And that could go into a several hour conversation. But if I could try to focus this lens a little bit, I would say that to understand where we are right now, Dalio is talking about the rising power, China, right? He's talking about, and actually, here's a framework for the viewers to think about the 5 Ds of inflation. Now, inflation, deflation. Going back to the Great Recession of 2008, when Ben Bernanke, Helicopter Ben, was in the Federal Reserve chairman seat. Everyone, including him, he was a scholar on the Depression, and everyone was worried about the Depression. And I shook my head big time, saying, this is not how the US is going to end out. We are so knowledgeable and fearful of the Depression but we are in a precarious scenario starting right around the turn of the century. And that's a separate conversation, but that's sort of my starting point. That we have been in the last 25 years in an increasingly precarious scenario. And that scenario would end up, always in my mind from the beginning, in inflationary spiral, but not without periods of deflation, which we have experienced. So think of how difficult it is to navigate that environment. But the reason why so think of back to the 5 Ds that lead to kind of inflation that we're in now. And think of the first one, de-globalization. Okay. That comes back to the rising power that Dalio is talking about. Now, there's other things to think about with China and the rising power, but one is that the US and China control global trade mostly. And so when we deglobalize those supply chains and corporate and country alliances and treaties and whatnot, that's inflationary. That's inflationary. Okay. That's the first D. And we're in that environment. And COVID really kicked it off, but you can't just blame it all on COVID. A lot of it has to do with the timing of China's rise and the natural end to their growth cycle, much like the US in the 50s and 60s, the post-war dividend led to the 70s. As you reach the end of that natural growth phase, China has reached that. And so once you reach the end of that, the playbook changes. So it's not just COVID, but COVID strongly contributed to that rise of China, de-globalization factor. And of course, the war in Ukraine and all these other factors, they all contribute. It's a soup. It's always a soup. That's why I'm a holistic investor. It's rarely one variable. It's always especially the bigger you talk, and the US is the largest economy, the more variables have to add up in order to move the aircraft carrier, right? So that's the first variable, right? 5 Ds, deglobalization. The second one would be decarbonization, right? Al Gore, the 2001, the inconvenient truth, right? 1.5 degrees Celsius. Everyone can look around and see that there are more weather-related events, fires, floods, etc. So the investment in green energy is huge, and that is also inflationary, right? Okay, so I don't think you need to expound upon that. The third one would be demographics. We had a baby boom in the 50s, and now we have a baby bust, and that's global. That's Japan. That's all of Europe, over 400 million people. That's all of the US. And it's accelerating to the downside. US used to produce about 4 million babies, China 10 million, and it's accelerating to the downside now. And there's multiple reasons for that we don't have to get into, but that's a fun topic.
That's the curve we're on.
So that's the curve we're on, the demographic side. Now Japan was now I'll just touch a little bit on that because it's important in history doesn't repeat it rhyme. So Japan went through that first. And Japan had obviously its own bubble in 1989, 1990, and had 30 years, 3 lost decades. Now, and a big reason for that was their baby bust. They were the kind of the front runner in this demographic trend. I don't see that happening for the US, and here's why. Okay, we have robots and artificial intelligence that will fill the worker shortfall. So we will have supply of workers that will fill the gap. But nevertheless, human workers, there is a shortage, right? There will be a growing shortage. That's inflationary.
Yep.
I don't see it being as bad as Japan because it's different this time because we have robots and AI, which are coming to the fore as we speak. Okay. So that I think is inflationary. Okay. And then debt. Okay, debt. Ray Dalio. Okay. This is there's a great firm in Canada called BCA, the Bank Credit Analysts. They coined a term many decades ago. I used to read them every month. They have a monthly newsletter, very well written, very well researched. BCA. They call it the debt supercycle, and that's what Dalio is alluding to. Is that there's these, great cycles that might happen every 50 to 100 years. Now, the why they happen is not something we're going to touch upon, but the fact that they do happen is a real thing. So we're in that scenario now. I think Jeffrey Gundlach, founder, CEO of DoubleLine, is called he's been dubbed the bond king. He took the role from PIMCO.
Yep.
Bill Gross. And Gundlach is talking now about this very issue where, by his estimate, the U.S. assets come up to about 190 trillion, and our liabilities are somewhere in the 210 trillion range. So we are technically bankrupt as we record this interview. And that's what Gundlach is saying. That's what Dalio is saying. But the key there is that it's not back to the aircraft carrier. You need more triggers. And because the US, the dollar is the world's reserve currency, everyone trades in dollars. The Federal Reserve has the ability to print endless amounts of money because there's endless demand for dollars. That is what would have to stop, I think, to really cause a massive crash. Now, Dalio is talking about, how if interest rates are going to stay higher, this is a key thing for our viewers, interest rates higher for longer. Okay, so they would stay higher for longer, if we had an inflationary environment. I've just been talking about the 5 Ds that are inflationary. Okay, so that is one reason why rates would stay higher for longer. And the debt scenario of one of the 5 Ds, of course, is debt. That structural imbalance is another reason why interest rates would stay higher for longer. And Dalio touches on that, right? So an investor would say, if your country is bankrupt, there's more risk. I want a higher rate of interest in order to account for that risk. And so you can get on that vicious circle of having to pay 4%, then 6%, then 10%, and so on. And as that interest rate rises and your revenues, government revenues, are stagnant, or in a recession they're going down, obviously, basic mathematics, you become even more risky and more bankrupt, and the likelihood of your creditors, the people that hold your debt, to call you on that grows, right? And so that plays into the other D, the de-dollarization. It's actually not one of the Ds, but it's related to de-globalization. De-dollarization is this concept that countries are moving away from trade in the dollar. That dollar trade peaked around 70%. It didn't last at that rate for very long. where I believe we're somewhere in the 60% range. That's a range that has held pretty strong for the last 30 years. And it's when it's going to start to get below that, which is going to happen here this decade for sure, I would say, is when it's going to start to get interesting, right? And then it starts to fall. And it's similar to what happened with the British pound from the World War I through the 1956 Suez Canal incident. That was kind of the last straw in the pound's reign. And the dollar is going through its own dethroning exercise, which is a multi-decade exercise. I'd say we're 25 years into it, is what I'd say. So that de-dollarization is another destabilizing fact, that as you move away from trade in dollars, the US has less power. And as its debts continue to increase, it becomes more unstable and it feeds on itself, so that creditors are looking to put their money in different places. And Dalio is saying, where is the demand for this debt going to come from? Now, in Japan, getting back to Japan, it came from the populace. So the marginal buyer in Japan during that period were the Japanese citizens themselves. So, in an environment where there was deflation in Japan, poor demographics, no growth, and they were living in an unstable environment. I think a lot of Japanese, I don't know this intimately, but you can imagine that they just said, we want something safe, right? It's not the go-go 80s. And so they were the marginal buyer. So is that what's going to happen here in the US? Is the US citizen even large enough to buy this ballooning supply of government debt? I personally think it will hit the wall. Okay. It's going to hit the wall. It's not going to end well. You don't see the discipline in America as a whole on spending and on the debt side, on the expenses side. I don't see the discipline there. And so it's not likely going to end well. But now, when is it going to end? That question, it can last a lot longer than you think. That's why Dalio is saying 5 to 10 years. That's kind of just parlance for kick the can down the road. And it's also the reason why Gunloch is saying right now that you can buy bonds, because he sees a recession in the short term, and that could be deflation. I'm here sitting telling you that I see inflation, but if you remember, I said periods of deflation. So if there's a recession this year in 2024 or early 2025, that's just a short-term period of market crash. It feeds to the volatility. Remember, Alan Greenspan left his parting gift in 2006 was a voluminous book called The Age of Volatility. So we're in that. We have been in that. People don't have perspective, right? We have been in a period of volatility since the dot-com era. So and it's gotten more volatile now. So that's the storm. The magnitude of the frequency is increasing, and so the cycle, I think, the point I was trying to make, and let me finish up, Sifu, and turn it back over to you, is that you look at interest rates. Okay, interest rates fell, like I said, from 82 to 2022 for 40 years. Well, in 2015, 7 years before they bottomed, the market was saying for 7 years, I'm just making that number up, a long period of time, but I'm not too far away from that. For a long period of time, market participants were saying, interest rates are going to bottom. They're going to bottom. They're going to bottom, right? But it's time to short bonds, right? That took a long time, but eventually we got there in 2022. Same thing here, right? You can make, it's like when you first start to hear the observation, it might be 5 or 10 years before it happens. Okay. But it's likely, very, very likely, especially interest rates, right? They were, the 10-year hit below 1%, artificially suppressed. And that's why I called it a fake recovery. They were artificially suppressed. That's what drove those assets up. All assets, right? And that's the other reason for this de-globalization, this destabilization. That's the rationale for owning gold and even owning some Bitcoin, because you want to look for something that is not a financial asset. You want to look for a real asset. Remember, real estate is a quasi-financial asset. So, gold, if you own gold itself, not an ETF, if you own physical gold, that is a real asset that can't be, devalued. So I talked about a lot there, Sifu. I'll turn it back over to you.
First, quick question for the viewers. Could you describe what the difference is between quantitative easing and printing money?
Hi, this is Sifu Slim, author of The Aging Athlete. In this book, you're going to get to hear about two different groups of former high-performance athletes. One group, which is made up of 90% of the former athletes, does not do physical activity on a regular basis and tends to suffer the consequences of a sedentary lifestyle. The other group, which is made up of 10% of the former athletes, is doing physical activity on a regular basis and tends to thrive through the aging process, or at least has a better chance at coping with the aging process. We could have taken these folks to a lab and done all kinds of tests on them. Instead, we slowed them down and sat them down and asked them, in their own words, to describe why they're wired the way they are, so that we all, former athletes and non-athletes, can use some of their inspirational and motivational and mindset lessons in our own lives. I hope you pick up a copy today. You can go to theagingathlete.com. And when you have a chance to read it, I'd love to hear back from you to find out what your thoughts are on the stories of these aging athletes.
Yeah, so the Federal Reserve has two main mechanisms by which they can, affect the investment environment. The first is money supply. They can print money and they can pull money out of the system, and then interest rates. They can raise and lower interest rates. So, and they have the flexibility to do one or the other, right? So they can lower rates. Okay, so right now people are talking, some of the market observers are saying, rates are coming, right? So we peaked in our rate cycle, and right now there's an expectation for 3 interest rate cuts this year, June, end of summer, like October, and then December. There was an expectation for 7 cuts. Right now we're at 3. Interestingly, it'll be very interesting to see what happens in June. Yesterday's CPI print was very important to watch, because if there's signs that inflation is going to reaccelerate or be more stubborn than expected, which is very possible, I don't know if it's probable, but it's definitely something to watch very carefully, then the Fed won't cut in June. If they don't cut in June, another guy the viewers should watch is Mohamed El-Erian. He's the president of Cambridge University in England and was Bill Gross's right-hand man at PIMCO and ran the Harvard endowment, and is wonderful to watch and listen to. So he's, he, like me, is thinking, that if they don't lower rates in June, they are really going to run the risk of being too late, much like they were in 2021, right? Where they didn't see inflation being a problem. And before they realized that it was a persistent problem, right? They called it transitory inflation, right? That was the key in 2021. That was the key term. The Fed was late and screwed up. They screwed up. And then they were just trying to catch the tiger by the tail for 2 years to tame inflation while the US population suffered. We could be facing that again if they're too late to lower, and it really creates a hard crash in the economy. And so part of what's going on now is, in my mind, that for many years the mantra was don't fight the Fed. And now I think for the Fed in recent years has been losing credibility. And if we had that outcome in June this year, it's going to contribute to their losing credibility. But to answer your question, they right now are talking about lowering rates at some point, likely June, but continuing to feed the money supply, right? So they can do both, right? They can increase the money supply, which is inflationary, and they can cut rates, which is inflationary, right? It's boosting. It's called dovish, right? So that's like beneficial. It's a tailwind to the economy. If they're adding money supply to the system and they're cutting rates, they're fueling, they're dovish. And if they're doing the opposite, they're raising interest rates and cutting the money supply, that's called hawkish. And that is a headwind to the economy. And the reason they do that is to try to fight inflation, to tame inflation, keep inflation closer to their 2% target.
So for some of the people, Jason, that haven't studied monetary policy, you can very simply go to Wikipedia, you can go to YouTube, and you can just type in monetary policy and try to find on YouTube a video that is for beginners. You could type in beginner's look at monetary policy. And here's just an example of what Wikipedia says about quantitative easing. Can you guess when that term was used? I'm not sure if it was coined then, but when it first became a regular part of the national media, take a guess in your and my recent times.
Well, it's not a guess. That started with Ben Bernanke in the Great Recession. And so that's when I called the fake recession, fake recovery, is because he was using that, back then in that era, he was taught we have more weapons at our disposal. So that's what he was talking about. And so he took that bazooka. That's why he was called Helicopter Ben, because he was just printing money and throwing it out. So that became quantitative. In the aftermath of the Great Recession, that was quantitative easing 1, then quantitative easing 2, and then quantitative easing 3 and 4. Once I started to see that joke, I think that was a joke. I don't mean to be flippant, but that's a separate conversation why I think that was not the right thing to do. But that became clear to me that at all costs, the Federal Reserve was going to prop this economy. And not take their lumps and just build the pain. That became the basis for which I said fake recovery and then a hard crash landing.
This is roughly 2/3 of the way into your financial career, correct? 2007 and 8, or about halfway. What would you say?
I was living in New York in '96, and so I call that as my mentorship training, but I formally didn't have a position in the markets until 2001.
So this is about halfway, perhaps, this 2007 and 8 into your financial official going to a job every day career?
Well, yeah, it was 6 or 7 years into it, yeah.
So here's what Wikipedia says, and I encourage people to read this. It's helpful. Quantitative easing, also known as QE, monetary policy action, where a central bank purchases predetermined amounts of government bonds or other financial assets in order to stimulate economic activity. And so this is a novel form of monetary policy, they say, that came into wide application after the financial crisis of 2007 and 8, which if I was in real estate at the time, and it took from a little bit into 2007, where the houses started selling much more slowly and a lot more came on the market, until somewhere between 2012 and 13, where you saw an uptick again. So that was quite a lengthy time on the real estate side. And it is used to mitigate this term QE, economic recession, when inflation is very low or negative, making standard monetary policy ineffective. And then there's, of course, the opposite, QT, quantitative tightening, does the opposite, where for monetary policy reasons, central bank sells off some portion of its holding of government bonds or other financial assets. So that's a really simple way to look at just one little piece of some of the options that a government entity has and try to understand how this is flowing. Now, you don't have to be able to predict these all the time because it's impossible to do. You've had a really good run at prognostication, but I would imagine that if you were in this market for 50 years, like someone like Ray Dalio, you would have had to have changed your thinking throughout that time to be able to repeat any form of prognosticating with any accuracy. And you'd have to be open-minded and open-hearted to allow that to come in. You couldn't be stuck in your old ways. So maybe comment on that.
That's a great point.
Yeah, comment on that if you would, Jason.
That's a great point. Yeah. So yeah, just on the QEQT, yeah, it's called monetization of debt, right? So we were talking earlier about who's the marginal buyer of government debt, and the answer is the Federal Reserve, right? So it's issued, they buy it, and they hold it. And I think before the Great Recession, the balance sheet was like 200 billion. Now it's like, I should know, but I want to say 10 trillion, something like that. It might be bigger, but it's just grown astronomically because they were the holders of that debt. So yeah, so that's a good point. That's the tool that Bernanke was talking about. But your point, your second point is a very important one. And yes, in 25 years, I have had to pivot. We're in a situation now where there's much more volatility, and it's a lot harder to be long or short market because of this volatility. And so I'm not a trader. I'm a long-term observer, historian. I've always believed you just got to get, the 10-year period right. What's right to own for 10 years? And then what's the next 10 years look like, right? So if you own Japan in the 70s, if you own, if you own Japan gold in the 70s, if you own Japan in the 80s, if you own US tech stock in the 90s, if you own China in the 2000s, you own the US S&P 500 in the 2010s. There's 50 years for you right there, and that's 5 trades. So if you get those right, yes, you should be diversified. And so within your risk profile, you have to decide, how diversified do I want to be vis-a-vis this investment thesis that I have? This is my 10-year. I think the next 10 years, it's going to be artificial intelligence and clean technology. Okay, so I want to own that asset, but how diversified with gold and emerging markets and U.S. government debt do I want to cushion that? So that's one thing for viewers to think about. For my pivot for this decade, it's that we're in this period of volatility. So I have had to challenge myself to try to be more of a trader. And when I say trader, I mean even 2-year periods, right? So, if the market's going to be up for 2 years, then down for 2 years, what's the right way to trade that? And for me, I've struggled the most in my career in these last couple of years to try to come up with a strategy that's going to work. But to your point, it requires an open mind. I have one. I don't enjoy doing that. It's not my natural way of thinking and operating, but I've told myself that I think that's the right way to try to play this market. So that open mind, the willingness to do it, and then taking the lessons. So, I haven't had a great last 2 years in trying to navigate these ups and downs, but I've been getting a lot better in the last sort of 6 months. And so what lessons can you glean in your pivot towards a different sort of play? Yeah. Or can you find a manager that is good, has demonstrated he's good or she's good at operating in that fashion that you want to operate in, and buy their fund instead of trying to do it yourself?
As a person who has a lot of background in investment, but also had to look into maximizing your annual salary and your annual fees that you could bring home to fund your life needs. You've mentioned a number of times with me in recent months about some new business activities that you're doing. I would imagine that you would rather have a lot of success in your startup businesses in a pivot like that, and have somebody else manage your money and get you 6 to 12% per year. Is that an accurate way to summarize where you are right now?
No, because I absolutely love investing, because I'm academic and I'm an athlete, and for me, and I'm a historian, and I think very I think the biggest thing, Sifu, is that I think very holistic in nature. Henry Ford and the revolutionary period, the French Revolution, the standard operating procedure, really doubling down on specialization is what our society has come more and more and more and more and more to. Being able to operate opposite that in a very holistic, general framework is the way that my mind works. Is actually, I think, I'm not anti-specialization. I obviously see a case for it. It's just that when all of humanity, focuses so intensely on that, and that's where the marginal returns come from, is that your efficiency, specialize, and you become your funnel gets tighter and tighter and tighter and tighter. That the human has no perspective at all, and so that becomes a societal problem, because at a societal level you have all these individuals that they don't necessarily connect, and they don't necessarily importantly see what's happening, and and that's from a macro level, at an investment, stock market, at a societal level, but it's also at a micro level, right? Within a family, within a community, it's too myopic. So for me in investing, to answer your question, I love being holistic, because I think that I know that in the markets, I've been successful doing that over 25 years. And so, operating my company is another thing. Actually, it requires, to operate successfully in a company does require that laser focus, right? A little bit of myopia.
Okay.
And so
let me challenge that. And this is, try to step out and be Jason Jewell at age 65 or 85, looking down at our conversation, because that's where I'm going to go as this, life coach and productivity coach. I'm going to look down at this, and based on what you just said, which I completely understand how you've operated in the past, and how you've been what we called an A-type with some karma, with some Zen, and with some heart, et cetera, with some authenticity, integrity. So now, jumping into your new company. So now Jason Jewell becomes something along the lines of Steve Jobs, which could mean the expansion happens so quickly, the technology steps in, and all of a sudden you're creating basically a monster, a very helpful monster for the niche that you're filling. And the calls just keep coming in. You've got family things going on. You've got your fitness and your athleticism, your social life, your spiritual life, all these things. But you do find another version, someone who thinks like you do, who's really good at picking, is the Jason Jewell at age 28, 35, that's doing all those things that you like, but he's allowing you, or she, the freedom to be all these other things that are expansive and very, what would I call that, labor intensive and time intensive, and top of the heap in terms of the phone call that could make or break your company. You're on that call, you've got your thought dialed in, you're Steve Jobs getting a new piece of technology, ordering the part and plugging that into the Apple of the 1990s computer, and then revolutionizing a niche market. But in Apple's terms, it was the global market. Yours could be global, the niche that you shared with me recently. So come down from that age 85 or 65, Jason Jewell, and tell me if what I said makes sense from a time management and a strategizing point of view.
I understand your question better now, and whether it's in a company or in investing, the same answer. That my answer is the same. So just take Ray Dalio, for example. So he's an investor, right? So he's playing that elevated role that you're talking about, bringing together all of his experience and wisdom and lessons that he's learned in order to see the biggest picture, without having to drill in and do a lot of the minutia. So yes, so absolutely. I think the beautiful thing about investing is that you don't just like look at Warren Buffett. He's like, you need to read as much as you can, read 10 hours a day, don't stop reading. So there's really there's sort of no escape, I think. Obviously you want to find a place. Okay, so I see where you're going with your question, and the 4-hour work week, right? And like work smarter, not harder, and all of those mantras and stuff like that. I think that to be very successful at something, if you're passionate about it, first of all, it's not work, so you enjoy doing it. But in terms of a higher functioning versus sort of grunt level work, yeah, I think you need to tune in and be conscious about what is the work that you're doing, right? And what is the payoff of that work, right? It's not necessarily that the goal should be to work less. It's that you need to keep producing. And are you with what you know and who you are and what your capabilities and what your track record demonstrates, have you aligned, your work that's producing an output that is in line with what your true potential is? I think that might be my response to what you're saying. It's not necessarily work less, because I think in investing, even if you are at this elevated level like Ray Dalio and Warren Buffett, do you think those guys are sitting back on their yachts? No. Warren Buffett is a workhorse at the age of 93, and Ray Dalio, these guys love it. They breathe it. And that's what I'm trying to tell you. I'm so passionate about investing. Now, when it comes to the business, and this would apply to investing, I do sort of have a roadmap. I want to keep the business. I don't want it to be huge. I don't have a vision for it being small and mom and pop, but so I have a real vision for where I want it to land in sort of 3 or 4 or 5 different sort of step levels, where at each level I would fill in someone behind me and elevate myself to a different hat and playing a different role. Ultimately, I would end up sort of as an ambassador to this company and brand that we're trying to build. And I'm trying to bring in investing to this business, and because I love investing. So I'm trying to kind of bring together all the things which I love, which is community, investing, and fulfilling a function of business, something that's
there's a social aspect to your business also.
Community, that's the community piece. That's the social piece. So those are the 3 things, 3, I can count, that I'm trying to bring.
There's also security. A big risk in the future is security, just like in World War II, when people are running off with the French art and these types of things. So your business provides security in a time of definite security risk. If the populace is not happy, where do people keep their collectibles,
So let's help the viewer. So we're going to launch this year in the late summer, early fall, a business called Cannon Vaults. Okay, and it's in Santa Barbara. We're launching in Santa Barbara. We are basically going to be a storage facility for high-end collectibles, and that's everything under the sun: baseball trading cards, art, jewelry, wine, watches, so on and so forth, right? And we're going to provide a highly secure, highly conditioned for humidity, light, temperature, and
24-hour access,
24/7 access. So that's very important, to have a non-banking facility with a real asset that is safe from physical theft, but also safe from cyber attack, and that you have access to, and you can move anywhere, anytime, sell, trade. In when times get tough, governments do strange things. The United States went bankrupt in 1933 under FDR. The ownership of gold was illegal from 1933 to 1971. So don't think it can't happen in this country. Greece, during the last, Great Recession, put severe capital controls. People cannot move their money out of the country. So the free movement of your assets is a luxury that if this conversation was hinting at that times are hard and they're likely to get harder, the governments then step in, and have and will make it more difficult because they're trying to control, right? They're trying to put a floor in. When the sky is falling, you put in a stop and say, no, you can't own this. You can't sell this. You can't have access to this, right? That's what the banking holidays were for. You can, think of gasoline in the 70s. You can only get gas on even days, right? If your license plate ended in an even number, whatever, right? So that access gets harder. So 24/7 access, the thefts and burglaries are going way up off the chart across the country. Here in Santa Barbara, Elon Musk yesterday and Bill Ackman, one of the top hedge fund managers, were talking about burglaries in New York, and so it's the threat is rising. The environmental threats are rising, right? So not to get too much off on this, but there's a strong.
You also have a social component, a community where you have a cafe/restaurant done very artfully with the flavor of a lounge, a men's lounge, women's lounge, where you've got nice settees for people to sit, to go into their vault and take out a work of art if they want to show their friends with whom they're sharing a cafe or a tea or a drink. You've got that aspect, so people can pop by for an hour or 5 hours and have that camaraderie and enjoy their collectibles and do some things mind to mind, heart to heart with people they know, and then maybe meet some other people while they're at your space.
Yes, we're going to do that, but importantly, we're going to do it very carefully. So we're really going after the ultra high net worth market, and we're going to have the lounge experience be very exclusive to them. So it's going to be very much a safe space for them to socialize and share their passion for whatever their collection might be, and create experiences, both social and learning around that. We may have someone from Switzerland to come talk about watches, or one of the top trending artists to come talk about their particular art medium. And maybe one of our collectors themselves would get up and talk about their coin collection. There's always a story behind it. There's always something interesting. We would have a top catered meal with great wine, so that you could have a 3-hour experience with some interpersonal connection, an amazing meal, and maybe an hour of talk with Q&A to create really interesting experiences. But we do want to expand the community, but we're going to do that. We're going to test that. We're going to do that very carefully. We're going to start with sort of a beta in kind of the aspirational millionaire, maybe the lower end millionaire, maybe someone with 1 to 10 million or 1 to 5 million, and smaller vaults, and give very limited access to the lounge for that collector type, to try to understand that type of collector, the way they think, how we can best serve them. And ultimately, if we're successful and we we aspire to do 10 locations. We don't want to turn this into a Hard Rock Cafe. We want to keep this a luxury boutique brand. We want to stay private. If in the news, if you see Soho House right now, that company has never been profitable. They have 42 locations across the world. They're expanding. They're not serving their customer. They're not staying exclusive. In my opinion, they're not handling it right. We want to go a little bit slower and make sure we're really maintaining exclusivity while we're looking for the next sleeve of customer to create a community around them. In my mind, like a second location, if we can prove this aspirational millionaire, we would have maybe a 50,000, 40,000 square foot building. And the first floor would be for the aspirational collector. Second floor would be the ultra high net worth collector. And we would have a rooftop patio. Each floor has their own lounge, and each floor would have their own programming. So for the aspirational first floor collector, it would be programming like you, Sifu. We would have life coaching. We would have executive coaching. We would have things that would be of value to someone who's 35, 40 years old, building their career, coming into their own, moving up from senior vice president to an executive suite, starting to make real income. They have a family. So their needs are going to be very different from a 60-year-old billionaire. Very, very different, right? Meaning their social needs. A billionaire needs to be very skeptical and very safe about who they spend their time with, right? So we're going to be very sensitive
they have
to that.
Bodyguards, right? Almost anybody with $1 billion has got bodyguards
Yes.
and special cars and gated homes and
Yep.
and securities, security professionals, either outsourced or in-house, where that person's job is just like some of the 5-star, 4-star hotels in Santa Barbara. They are known for their high security systems. And if you go in and walk into the place, they already know your license plate. It may already have I would guess it has a program that runs your license plate, and you walk in there to drink, and there's people watching you and walking around taking a look at you, not just to see the person that has a potential weapon with them, but just to see who fits that spot and who could come up and be a bother, because there's a lot more bothers out there and paparazzi to clientele than there are people trying to hurt them. They just don't want to have their clients, their customers bothered by people who don't know how to handle star power and billionaire power.
Exactly. So that's the type you did a great job explaining. That's the type of client and the type of needs that they're going to have. That'll be very different from the aspirational millionaire. So we would like to develop that so that we can be inclusive in a very smart way and cater to those customers. And honestly, if we're successful with the aspirational millionaire, there may be scope, and this would be several years down the road from now, to be even more inclusive, to create another circle, invite them into the aspirational millionaire club, right? Yeah. So to expand the community, we will only do that if it makes sense. It's something that we're going to watch. And back to the investing side, to tie this whole conversation together, is everything that we're talking about. And of course, this conversation just scratches the tip, right? These are, that's why, Joe Rogan has 3-hour conversations, right? It's a long journey to really understand and contextualize the investment environment properly, right? So we're just scratching the tip, but that type of programming is exactly what I want to bring to our lounge, our social club, to bring very relevant, actionable, intellectual content to our vault customers and ultimately bridge the gap. All right. One of our main goals is to bridge the gap between art and investing. If you look at the UBS art report, they produce a 300-page annual report. They about half of people buy art through arts and culture and passion, and the other half buy through research and investment. And so the program, we want to have both sides. I want to be the program director for the investment side. We want to have a newsletter, and we want to have great content. And I also want to have a program director for art. And so we can bring guest speakers and really interesting programming that speak to both the art and culture side as well as the investment side, and ultimately do the work to link the two, to see how does art and investment how do they interrelate? Yeah.
Part of it's a presentation too, because speakers like me, I've written 7 books now. We need to be what's the word called, showcased to people who have high net worth, who know how to get from A to B to C to D, to make something happen and make change in the world. It takes organization skills, it takes innovation, and it takes assets and many more things. But people who spend a lot of time creating content, helping regular people and some higher net worth people, to help nationally, internationally, globally, we need to have people who see us and help us position ourselves. For example, getting on Oprah show or the current version of the Oprah show, getting on Rogan. A person who's a billionaire or a multimillionaire or is just a contact of Rogan, let's say they invested in something that Rogan, they met, blah, blah, blah. They can get a phone call into Rogan's secretary and they can get somebody, me, on the show. And if I do well, Rogan could have me back 8 months later, 2 years later. And that becomes part of my profile. And I bless Rogan with some really good content, information, entertainment, etc. And he blesses me by helping me expand my audience. So this is a great interplay of the intellectual, hardworking side, people like me, and the people who have already done great work in expanding their businesses and their assets, who are looking perhaps with some of their time to connect people to the right things, to bring about change in the world and to bring new information to the masses, let's say.
Yeah. And getting access to that comes down to what do you know and who do you know, like always. So I think I have a very unique perspective on the markets based on my 25 years in the market. There's more than one way to skin a cat.
I think you had it when you got in. I think it was,
Yeah.
I wouldn't even say it was experiential. I think you had it when you got in, and you kept pivoting. You know, you kept working hard and pivoting and learning, but you already had the open mind to receive that download. So if you didn't have that, I don't think you would have had that 25-year run.
The open mind and the framework, the mindset. So that's exactly why I'm always open to young genius as well as old. I think the old and experienced just becomes a validation that there's a track record that you have done well, so that it's not just talk. You know, if you're 25, it's, you know, and Warren Buffett has done that, right? When you meet someone special, you know it. Right. You know it. You ask the right questions, they give the right answers. But it's also a je ne sais quoi of like, you know, who is this person? What do they bring? You can't necessarily, you make a bullet list of that. You feel it. And so, you know, the lady that he brought on, I think at 25, that she's now 39, and she's created a mini Berkshire Hathaway, was a perfect example of Buffett bringing a young woman in. And there's plenty of other people that have come to him that he's like, yeah. You know, obviously that happens daily, I'm sure. So yeah, I think I had that, you know, at 25, and now at 50, I, you know, have, I think, validated that. But again, the key is that, you know, in this access, in this discussion, it's, you know, how do you see things differently, and what is the value in that? That I think, you know, for anyone that is just interested academically or is looking for ultimately a policy decision or a playbook. I mean, this comes down to even, you know, a lot of billionaires right now are building panic rooms and underground tunnels. Like, they're very paranoid about the level of safety and the way things are going. They're worried about, they see China, they see the wars in Ukraine and Israel, they see the debt, they see all these things are clear to see. So what exactly? So like, think about in the 1930s in Poland. I'm not necessarily. I do think that World War III is a possibility, if not already early in the making. Dalio has posited on that, saying it's coming and the risk is now lower. But I think everyone has that on their minds. I think when you look at World War II, they didn't call it World War II until the end of the war, but you had, you know, it was the war in the Pacific, right? So, but we were in World War for a long period of time. So the question is now, you know, Taiwan, you can see China, they're not prioritizing growth. It's a huge shift. They're prioritizing security, and they're investing heavily in their military, and they want Taiwan. That's it. So that's clearly coming. So how do you position for that? And what do you know? So I think getting in circles with people that have thoughtful conversations about navigating the next 10 years is what we want to do at Cannon Vaults, you know. So
let me jump in. Thank you, Jason. The idea I wanted to share with you was one of the great 10 lessons of business that someone shared with me. And this business idea also translates to people helping you with your own health, with your own decision making in terms of life coaches, psychological counselors, business planning type people, business strategists, business coaches, these types of things. So a friend of mine, Dr. Paul Kasilowitz, podiatrist in Sacramento, he's from Cleveland, Ohio, humble roots, but got his MD, a great athlete, great basketball player, hard worker, wife and couple of kids who are out of college by now, kept his basketball going, started a couple other side businesses. He told me way back when I knew him, when I was a young dude, he was a couple of years older than me. He said, somebody taught me, and this is a lesson somebody taught him. Thank God that we pass these lessons down. He said, always hire people who are smarter than you are. So when I say that, it doesn't mean they've read more books, they've got a higher IQ, they went to a better college. It means on what they do or what talent they have, it's higher level than yours is in what they do and what talent they have. So, for example, I'm this guy that's big on balance. So when I talk to a guy like Jason, who's a top athlete who can really go for the high performance mode, right? I want to make sure if I'm his coach that he's a sustainable Jason, that he's got some downtime to think and to process all this information and thought in the meetings that he has with other people. That would be an obvious thing for someone that we just mentioned, an A-type person with a heart. So that's one little piece. So, hiring people who are smarter than you, that means slowing down, getting a business coach, a life coach, and allowing those people in their own expertise to be thinking about you before their next appointment. So that really helps the high performance people or someone trying to get to be a higher performer in their career, in their life. Over to Jason for your thoughts on that.
I love it. I think the saying is A's hire A's and B's hire C's. So that's the ego is an important thing that operates in human work relationships, and it's, I think, knowing what your value is and knowing where your blind spots are. I think the earlier you can learn that, the better. Going back to squash, where you're an old ambassador at the age of 30. And you're starting out at the age of 18. It's a small window. It's a condensed life cycle, 12-year life cycle for my sport of squash. And the guys that can really learn, where their blind spots are and where their value is on the squash court, in the top 10 in the world, that can be the difference between number 1 and number 5, honestly. So it's that mindset and that shift, which is really an ego thing, and having, it comes back down to having an open mind, being humble, being authentic, being realistic, being committed, and not being insecure. Everyone has blind spots. So what? Own it, and work on it. And in a work setting, hire around it. Hire someone to plug your gap. And that's where A's hire A's. So I agree with you wholeheartedly there, Sifu.
Final observation, Jason, for you to share your point of view on. So I'll bring it up to the here and now with some news that may be some new news to you and the viewer. So here in Playa del Carmen, there are a lot of Canadians, and Canada comes from, I think, socialism done mostly well. And that doesn't mean a government running your lives. That means when you're 28 and you've got a 4-year-old kid, 6-year-old kid who wants to go to swimming classes, it's covered for you. Isn't that cool? And the supervision of your kid while they're there is covered for you. It comes out of your taxes. Of course, your taxes are higher, but think of it this way. How many people who are rank and file, middle class or lower middle class, that have 2 to 5 kids can afford all the maintenance stuff and the development stuff for a kid? So that's my one little piece of the equation on Canada. There's some downsides, waiting for elective surgeries, even if you think the elective surgery is really important. There's a lot of downsides to some of that as well. But there are a lot of nice people, a lot of caring people in Canada. There are a lot of people like people from current, 2024, more like the people in America were in California, let's say New York, in the 1980s, kind of like Des Moines, Iowa. I met some people from Des Moines, Iowa this morning. Very similar in disposition to Canada, very simple oriented, very kind-hearted, and very family oriented. So here I am in Playa del Carmen with all these Canadians, lots of Americans, lots of international people, and also Mexican tourists from other cities and Mexican workers, mostly not born and raised in Playa del Carmen, working here to support the 300,000 people who live here, 25% growth rate over the last 15 years per year, one of the fastest growing cities in the world. So now I'm going to bring you up to speed on what the apathy and the stress and the dissatisfaction is with many Canadians, age 22, age 72. This is what I found. These people are ticked off at their government because their government is printing money out of thin air, just like most of the Western style democracies and banking institutions of the world, which is a huge part of the world, printing money out of thin air for a long time, maybe 10 years, maybe, just to exorbitant amounts that Ray Dalio thinks is folly. And so these people that are here, many people, middle-class people, that I'm sharing conversations with, they're frustrated that their government is asking them to still keep paying taxes when the government is just printing money out of thin air and oftentimes benefiting the corporations and the banking system more so than the average person. So this, in my opinion, leads to dissatisfaction, leads to apathy, and leads to just this general malaise where you could, when you're in a situation where the constituency, the regular rank and file people are ticked off, that's going to impact the elite and the power elite. And then there's going to be this friction between the two. So you've got this ticking time bomb of people being just the wealthy top 1% being fretful that these other people are going to overthrow them, like Louis the 16th in France in the French Revolution. He gets guillotined, his wife gets guillotined, they're in prison for a while. Horrible economy. The French people think that these people don't care about them. It's a rough winter. They chop down all the trees in the Paris area, no wood for the fire. They say, we're going to Versailles. We're taking this king and his wife and his family, putting him in jail, and we're going to guillotine this guy. He tries to escape. They bring him back, guillotine, end of story. So these are some geopolitical things. I wonder if you could wrap our conversation up with apathy, psychology, and malaise, and how that affects geopolitics and the financial markets.
Thanks, Sifu. So the Canadian example is important because, again, in the context of this conversation, what's happening. So one of the things that you've given me the opportunity to plug on, what is happening? This is not just a U.S. problem. U.S. is probably the epicenter of financial mismanagement, right? But this will end in a global restructuring. All these fiat currencies are being devalued, and this is a global problem, Canada not excluded. So that's an important thing for investors to keep in mind, that this is a global problem, and in that context becomes a race to the bottom. So that's a different discussion, but it's an important thing to keep in one's mind. Now, Canada, I lived in Canada for 3 years. My grandmother was born and raised in Toronto, and I've always thought of Canada as one of the best countries in the world. And here's why. They're a relatively small population with controlled growth. They will allow, Asians into their country, particularly in the West, and those workers contribute high value to the economy, but they're not profligate and just it's more controlled like Australia, New Zealand. They don't just let anyone or any number of people and I'm not an expert in Canada, but my knowledge, my thought is like Europe was way more open in refugees, just letting floodgates. I was in Germany in 2016, where just the Turks and just the was it the Syrian? I can't remember. They were just flooding into Germany. I was in Hamburg at the time, and Canada has been way better at letting closing the door but letting the right people in. They're a small country to begin with, so it moves the needle more by letting people in. That's number one. Number two, they have they've had a peace dividend with the U.S. being their neighbor. And they have great academic institutions. They have an incredibly well-rounded economy from mining to banking. So they, and they're wonderful people. And Canadians are the nicest people on the planet. And so socialism can work, capitalism can work. They have to work both under the right conditions. You can't have Europe where people want to stop working. They want to work less. It's a 40-hour work week. Then it's a 35-hour work. Then it's a 32-hour work week. You can't do that with a rising power like China. You can't be lazy. Okay, you got to work. That doesn't work. And then you have more people coming into the country, and it overwhelms the socialist system. You literally, when I was there in the late 90s, it was very clear to me that Europe, I was in Spain at the time, it's like live to work versus work to live argument, whatever. To me, that was always not going to work in Europe. Not saying anything against socialism, or I'm not saying anything for capitalism in this argument. I'm just saying that both systems have to operate under the right conditions in order for them to work. And I think Canada has done, to your point, Sifu, a good job at doing that. And it's ending because it's ending everywhere, right? So you can't have this floodgate, right, of debt and money printing. It will end in tears, right? And we're on our way to that. We're in the middle of that sentence, right?
Can you speak to the apathy and malaise portion?
Well, it's everywhere. Look, you don't have to go to Canada in Playa del Carmen. You can go to the United States. You can go anywhere. You can go to Europe. It's people feel malaise. We have a populist moment, right? That's another thing you hinted at. We haven't gotten into this conversation. Dalio talks about that, right? You can't have a populist movement where it's a stratification of the populace, mostly through a wealth gap, right? And we have had that over the last 40 years, right? The rich have gotten richer, right? And I always think of Hank
to an exorbitant amount.
It's just, yeah. I mean, when you're lowering interest rates, okay, like just think of the last post Great Recession. Okay, so you're lowering rates. That helps financial assets. So if you have financial assets, just if S&P 500 index, you tripled your money in 10 years, something like that, right? Okay, but you have to have money in order to triple it, right? So if you don't have any money in your 401k, I don't care if it's $50,000 or $500,000, you don't get that triple. You don't experience that wealth effect, okay? Because it's come in the backdrop of deflation, right? And so when you had China rising, you had their whole workforce as downward pressure on wages. And so that's why you had the pigs in Europe, right? Portugal, Italy, Greece, and Spain. Those were the pigs. You had them increasing their wages, right? They became less and less competitive with China, and we know how it ended up with the pigs, very poorly. Whereas in Germany or the US, you hold, like in the US, you held wages fairly flat, okay, which is in an environment where, things are becoming more expensive, like to own a home, the price of a home goes up, your wages stay flat. By basic mathematics, that house is now more affordable. But you held wages flat because you were competing with China. And if you rose your wages, now you became less competitive with China. So that push-pull, we have all kinds. We have had, we do have, we will have all kinds of push-pull going on in this global economy, where it's not just the US anymore, it's the US and China, and everything is relative to everything else. And that push-pull creates impossible situations, right? And so that is why you had this stratification wealth gap, because if someone had $1 million, that becomes $3 million, and then you put in Bitcoin, and now it's worth $30 million, right? And so you had, people, becoming very wealthy through that kind of effect, which is really making money available, right? Money printing. There's more money in banks. Anyone with a heartbeat can get a loan, right? You can use extreme leverage. Interest rates are extremely low. so you're credit worthy, you own a house, whatever, you have $1 million and you get your loan. And now you're from your financial assets and from your business, you're creating massive amounts of wealth. If you're the regular guy working, on the floor of some power plant or something, you have no financial assets. You are not benefiting from that tailwind, and your wages are flat. So you are just going downward, and that creates populism, and we have populism, and that creates political angst, and people are not educated. They're very emotional, as they should be. They're frustrated, they're angry, right? They can't get ahead. The American dream is dead. Why should I invest in education, right? There's no return on that investment. I can't own a home, right? And people are just trying to respond to that with their pitchfork, right? And so there's no national dialogue, there's no cohesion, right? There's no common goal. Dalio talks about that too. Dalio is very principled, right? So what are our American principles, right? What are our goals? What are we all working toward? We had that in the 60s, right? So we don't have that today. And Dalio is very clear about that, is that we need to get through this period in order to reframe. We'll have new goals, right? Beating the environment, right? Whatever they may be, right? Focusing on happiness, right? Whatever those goals may be, inclusivity, right? Respect. These are the goals that are certainly bubbling up and are in all of our collective minds, right? So, until we get to that moment, and until we have this real Basel III, Basel IV, whatever, a global, financial restructuring, and there'll be a lot of financial angst, turmoil, volatility, most likely war, World War III, most likely. All out. And so we have to get through that very tough period, in order to come out, Phoenix from rising from the ashes, for us to come out on the other side and let all of these growth engines bloom, meaning AI, autonomous vehicles, smart cities, telemedicine, genomics revolution, new space race, robotic technologies, and on and on and on. Just study Kathy Wood at ARC, right? She's on to all of those. All of those technological lovers are going to be huge tailwinds, but we will never enjoy those tailwinds with all of these structural headwinds. We have to go through the geopolitical restructuring. China wants Taiwan, and all these alliances, the petrodollar deal brokered by Nixon with Saudi Arabia in the 70s, that's over. So all of these relationships, alliances, trade, political, geopolitical, military, they all are being remapped, but they're not settled by any measure. They need to be settled into a new world order, to use a term that's always used, and geopolitically, but also financially. There'll be a cryptocurrency. There'll be, a blockchain. They call it government-backed digital currency, GBDC. You're going to have that blockchain ledger where everything is accountable. No more cash, sadly. This is the world that we're going into, people. So, like it or not, I don't necessarily like it, but as an investor, as someone, you can fight against it, or you can work with it. You're gonna fight upstream like a salmon, or you're gonna allow the winds to go at your back and try to navigate your life and your investments with the wind at your back. That's a personal choice. I believe these things are going to happen. I believe they are happening, and how everyone on this channel positions themselves, it requires a personal choice if that aligns with your values and wishes. It requires a intellectual choice too, to make the right financial decisions. And it might even require moving, like you did to Playa del Carmen. If US is ground zero, I'm not advocating this, but certainly I'm a citizen of Spain. I could go live in the Azores if I wanted to. Having flexibility is good because you don't know what's going to come. We're definitely in an environment where that risk is rising dramatically. And the first thing is, how are you going to manage your family? How are you going to manage, your career so that you have cash flow? How are you going to manage your investments so they're protected? Then you start to think, well, is there upside? And then do you think, at the next level, ultimately, am I safe where I am? Like you go through that thought exercise. And, if the risks is rising, it is possible that you might come to the conclusion that, I need to move, right? Obviously, we're not there right now, but I would say the yellow and red flags are starting to rise. So these are all things that the viewers need to think about, in my opinion. Yeah.
Mm-hmm. Final thought, Jason. Appreciate that last explanation. The idea of looking at broad swaths of human practices and ways of survival, ways of defense, ways of raiding. I mean, a lot of Survivor happened. Genghis Khan and these types of people were raiders, and they walked through, rode through, vast parts of Asia and other distant lands, and part of the raiding, and that was the way they survived, by raiding other people. And the Roman the legions weren't mostly fighting, they were mostly living in places like Spain and France, and got all the way to England, and they set up shop and lived there, and they were part of the community, and they had the backing of their legion if they ever needed it. But most of their day was just living a normal life and eating and gardening and farming and being educated. Of course, yeah, Roman legions wanted to have some education, but they became part of these communities, and then they, the engineers work with them too, part of the legions, and they built the roads, they built the aqueducts to bring in water, and they built castles and these types of things. So they're constantly building. So what I wanted to share with people is something I learned about samurais. And in the movie, they're romanticized and almost horrified as, this band of people with these long swords that come through, and they ginsu everybody in the stomach, chop off some heads, have these slow motion flying kicks and all this type of stuff. Really what the part of the samurai was to defend their temple. So if these are people who are spiritual, Buddhist practice, etc., they're in this temple with bamboo walls. Any other warring person or somebody they threw out 6 months ago or 10 years ago could get a couple of other people, or they themselves, the person who threw it out, could come in. And if the door is locked, it's very easy to break down a door with your body or light it on fire. So these samurai sitting practice that I did over in Hawaii at a Buddhist temple, where they did teach martial arts, where they did teach calligraphy, where they did teach the philosophy and meditation. I'm sitting with a pillow that's angled down, trying to help my posture maintain, and being with the concept of thinking one. Whenever your mind wanders, we had to just say to ourselves, we're looking at the same spot. We're not looking around, we're not thinking, we're not breathing. It's all just one, and maintaining that posture for an hour in the beginning, an hour and a half, and the advanced people are doing 2 hours. What I learned about the sitting practice is that no matter when you do that, or when you do your calligraphy, when you're doing your food preparation, the people in that temple are ready 24 hours a day to defend that temple. That's one of the main takeaways from learning about the samurai, is they are there to defend their temple. It's their living space. It's where they process their food. It's where they use the facilities, where they gather. And that's what I'm suggesting that people start thinking about, instead of trying to bombard yourselves with new books and new information and new YouTube videos and new cafe mochas and giant sugar drinks. Start thinking more like you are this entity you've got 2 people, 3 people, you've got a group now of people like-minded, some people call it, like goals, and you're helping each other concentrate on the idea of making the right decisions. One of those decisions is to defend your house and the place that you get your food from. So in Santa Barbara, for example, I would want to defend Trader Joe's because that's where I buy more than 90% of my food. And that would mean defending the trucks that come in, defending the employees. These are real things. And if you don't think they are, think of the invasion of Ukraine that just happened 2.5 years ago. Over to Jason for a final comment, and we'll wrap.
I love it. I love Sifu. That's a great comment. I commend you on it. And I think of, well, first, samurai like the Knights Templar, right? So I love the samurai and the Japanese sentiment. But in terms of personal practice, I love that. So get your spiritual house in order, however you define spirituality, so that you can have the mind and heart and space to make good decisions, right? So I love what you just said, and I do think about a little movie. It's always fun to end in a visual called Defiance, which took place during World War II. True story, 3 brothers. They basically lived in Belarusia and ended up saving 1,200 Jews from the machine gun of the Nazis. And at one point, they were living successfully in the forest, defending themselves, nomadically moving when they had to. They were attacked and bombed. And they were at one point very stable, and they went into one of the ghettos and met and sat with one of the rabbis and implored them to come with them, that they could provide safety and security. And the rabbis conferred. There were 3 or 4 of them. They huddled and conferred and ultimately scratched their beard and said, "Thank you for this offer. We are going to stay here. We feel that we're needed. We're accountants and tailors and so on. And the Nazis, they need us." That was their determination. So I think we all have blind spots, as I've said, and I think it's important to understand truly the moment and how you're positioned in that moment. And having that personal practice and spiritual meditation, right, to get your mind to see the picture clearly, so that you can make a good decision, hopefully better than that rabbi. I'm sure it was his undoing, because that was not a good decision, clearly. And so I hope that this viewership would heed those words and create an open space so that they can, whether it's an investment decision or a personal decision, they can see the situation for what it is and make good decisions.
So thank you, Jason, for that wrap. That was wonderful. I want viewers, people who wish to contact Jason, don't share your email this time. We'll just share that you have a LinkedIn page, and through that, for people who are members of LinkedIn, they can contact you through your LinkedIn. It says Jason Jewell Consulting on projects and startups in various industries. You'll be able to find Jason through there. And if you want to have him on your podcast, or you want to reach out for some consulting, connection, etc., that's one way you can do that. And we're asking you for your likes on YouTube here. Please like right now, and please subscribe, and also please share this on your social media platforms. We are here to help you. We want to find your comments down below this video, and we'd like us currently, and maybe our staff 5 years from now, to help respond to those questions and lead you in the right direction. We think that we're pretty good at finding out what is BS and what is nefarious in terms of characters out there in the world that are messing things up and enriching themselves, be they psychopaths, sociopaths, narcissists, sadists, whatever, they're out there. We're hoping that you take a good look at this, realize that we're here to help. Empathetic, yes, but we want to coach you like, the Joe Paternos of the world back when he was at his high performance, to your best performance, so that you can survive and you can survive and thrive on this wonderful journey we call life. Last comment from Jason, then we'll say goodbye.
Oh, no, well said, Sifu. Thanks for inviting me. And yes, please like this video and support Sifu. You're doing good works and producing good books. So thanks for inviting me today.
Wonderful. And we'll talk again very soon. Best of luck with your projects, your squash. Hold up your hand so we can see that you have to. Oh, it's your right. It's your, yeah, you're right. You
My right hand.
What were you doing? Rollerblading?
I was rollerblading, and yeah, we're launching Cannon Vaults probably between September and November, and the World Masters in squash in Amsterdam is at the end of August. So I may not be able to play this year, but I'll play some tournaments, and eventually I'll get to the World Masters.
And you need your left hand's uninjured, but you need your right for balance, and it gets a lot of movement. Is that the idea?
Well, and also you mentioned balance. So right now it's hard to find balance because launching a company is full on. So
maybe the following year.
Yeah, it's every 2 years. So maybe in 2 years.
2 years, okay.
Yeah.
Well, maybe this is interesting because I just sliced open my foot on a piece of metal about 4 weeks ago. And, you know, in Mexico, unfortunately, the laws and the code for doing work don't always require things beyond ripping out the old. They might rip out the old portion, but leave the foundation of the old part, not removing it. So I'm walking in the dark, sliced open the left side of my foot. But what I did is I kept doing my fitness. I put a latex thing over it so I could keep doing my swimming. And it gave me 2 weeks of recovery there where I was highly productive in all these projects that I'm doing. So maybe that will be the same thing. It's like a karmic thing to focus on some of these other things and tell the squash tournament you'll be there in 2 years.
Yeah, exactly.
Aloha, brother. We'll talk soon.
Okay, cheers. Bye.